Many people ask me the real secret to building massive wealth, and I always tell them the exact truth, but nobody wants to believe it. They prefer the flashy lies and the fake gurus selling overnight Lamborghinis, while the real money is made by being incredibly boring and unimaginably patient. Right now, Bank of America just published a private research report that sent massive shockwaves straight through institutional Wall Street. The literal title of this official document is "The Door to Doom Has Opened." This is not some cheap internet clickbait, and it is absolutely not your typical financial doom and gloom video. This is one of the single largest banking institutions on the planet warning their billionaire clients that a critical threshold has officially been crossed. This exact same mathematical threshold has preceded every single major market crash in modern history. And the truly terrifying part is that almost 99% of regular retail investors have absolutely no idea this happened. Naturally, Wall Street is not going to mail this report to your front door or talk about it on the evening news. They keep this life-changing research locked away for the big institutional funds who manage billions of dollars. But today we are changing that because I believe you deserve to see exactly what the smart money is seeing. They also do not want you to realize that every single historical crash creates a rare window to turn $10,000 into $100,000 in less than a year. The only real question is whether you will be mathematically prepared or whether you will panic sell at the absolute bottom like everybody else. My name is Felix Breen, and I have spent the last decade studying market crashes not to lose sleep but to profit heavily from the chaos. I am sitting out here in the beautiful south of France right now, and I am honestly pissed off that this high-level data is hidden from regular hard-working people. So I did the heavy lifting for you and translated their complex financial jargon into a simple beginner-friendly guide that you can understand. Let us dive straight into what Bank of America is actually saying for those who possess the true patience to survive what is coming. The very first alarm bell in the report is what they call the Maginot Line of the global financial system. To keep it completely simple, imagine a massive concrete dam holding back billions of gallons of raging water. For the global bond market, that protective dam was the 30-year United States Treasury yield, and that 30-year yield just broke straight through the critical 5% mark. Let us strip away the confusing jargon because the bond market makes most people want to fall asleep. When you lend your hard-earned cash to the government for 30 years, they agree to pay you a specific annual interest rate, which is called the yield. For decades, this specific interest rate has stayed safely below the 5% threshold. When it aggressively crosses above 5%, it means global investors are suddenly demanding way more money because they smell extreme danger. Smart money is getting incredibly nervous about government debt, and the dam is officially showing massive cracks. Bank of America studied every single major speculative bubble in modern history, including Japan in 1989, the dot-com crash of 1999, and the Great Recession of 2007. The mathematical pattern was entirely identical across every single era. When long-term government borrowing costs shoot straight to the moon, the artificial boom times instantly come to a grinding halt. According to the analysts, there is absolutely no silver lining to this first warning sign. Now let us move to alarm bell number 2, which is the historical 4% inflation rule. The researchers looked at over 100 years of continuous market data and uncovered a remarkably simple mathematical reality. Whenever core inflation sustains itself above the 4% line, U.S. stocks historically drop an average of 4% over the following 3 months. That might not sound like a massive deal to you at first glance, but the data shows those same stocks then proceed to drop an average of 7% over the next 7 months. Right now, consumer prices are rising at almost 4%, while producer manufacturing prices are skyrocketing at over 6%. When those massive manufacturing costs eventually trickle down into retail shelves, your money loses its purchasing power and you are forced to buy less stuff. To fight this sticky inflation, the Federal Reserve is forced to aggressively increase interest rates. Higher borrowing costs completely crush corporate valuations, while energy costs, electricity prices, transportation, and housing rents go up simultaneously. Bank of America projects we are heading straight toward 5% inflation, which means this is no longer a theoretical exercise. This is 100 years of concrete historical data staring us directly in the face. The third alarm bell they highlight is something they creatively call the Alligator Jaws. Picture a massive alligator opening its mouth as wide as humanly possible. The top jaw represents the stock market, which has been pushing higher and higher on pure hype. The bottom jaw represents the bond market, which has been crashing lower and lower. Right now, we are witnessing the widest gap on absolute record between stock performance and bond performance. The fundamental problem with alligator jaws is that they mathematically always close. There are only 2 ways this gap closes over time. Option A is that the stock market crashes violently downward to meet the bond market. Option B is that bonds recover rapidly, which requires inflation to magically disappear overnight. Since inflation disappearing overnight is highly unlikely, option A is almost always what happens throughout financial history. And when that jaw snaps shut, it happens incredibly fast. Every single unnecessary dollar you spend on stupid consumer items is a loyal worker you just fired from your wealth-building army. But here is where the story actually gets incredibly exciting if you know how to play the game. Crashes are the ultimate wealth equalizers because they literally create the next generation of self-made millionaires. Let us look at the actual data from the 2020 pandemic panic, when businesses were locking down and unemployment was exploding. If you had the courage to invest $10,000 into a beaten-down company like Freeport-McMoRan, you would have had $98,000 just 24 months later. That is nearly a 10 times return on your money, while everyone else was crying on social media. If you bought Royal Caribbean at the absolute dark period, you would be up 9 times your investment. Zoom went up 7 times and Block went up 7 times. The average winning stock rallied by a factor of 5 in less than 2 years. If you go back to the total devastation of 208, you see the exact same pattern play out. Royal Caribbean went up 9 times in 22 months. Bank of America, which the public thought was completely dead, delivered a 6 times return. Caterpillar went up 5 times your money in about 20 months. The vast majority of retail investors panic during a crash because humans are hardwired to buy high and sell low. The wealthiest investors study the mathematical patterns and aggressively buy assets when there is literal blood in the streets. I cannot tell you if the big drop happens next week, next month, or 6 months from now, but I can guarantee you with absolute mathematical certainty that a massive 30% market correction is coming. You need a strict rules-based framework so you do not just throw random darts at a board when the panic hits. I am currently putting together a highly detailed workshop called the 10x Crash Returns Blueprint to teach people how to spot these hidden winners before they run. We will break down which specific sectors produce the absolute biggest gains and the exact indicators to use, so you avoid deadly value traps when the stock market artificially goes up. People experience what economists call the wealth effect. Your paper portfolio looks amazing, so you feel rich and spend more money at local businesses. Companies report higher earnings from all that consumer spending, and the stock market pushes even higher. It feels like a beautiful, endless loop of prosperity. In fact, U.S. household stock market wealth shot up by $4 trillion just this year alone. That follows a $10 trillion gain last year and $9 trillion the year before that. But you need to realize this is not real tangible wealth. It is purely paper wealth that only exists as long as stock prices continue to defy gravity. The absolute second the macro cycle reverses, that artificial wealth completely evaporates into thin air. Bank of America explicitly notes that this artificial boom loop will end due to 2 factors, which are politics and bonds. Right now, the smart money is highly concerned about the extreme concentration in semiconductors and artificial intelligence chips. If you look at the long-term 200-day moving average for the tech sector, we are currently sitting 60% above the normal trend. Think of the market like a thick rubber band that is being stretched to its absolute maximum breaking point. Eventually, that rubber band snaps back violently, and it severely hurts the people who refuse to let go. Bank of America compared this current tech chart to only 2 other specific moments in human history. The first was the catastrophic Mississippi bubble in France during the early 1700s, which caused total financial ruin. The second was the infamous dot-com bubble of 1999, which instantly wiped out trillions of dollars of wealth. Furthermore, the concentration of wealth in just a handful of massive tech stocks is currently higher than it has been in over 50 years. The top 10 stocks in the S&P 500 have driven over 72% of the entire market rally this year. The other 490 companies have done basically nothing. This means the entire global economy is resting on an incredibly fragile foundation of a few chip companies. If the AI hype cycle slows down even a little bit, the entire market faces a massive systemic drop. In 1989, Japan experienced the single largest asset bubble the world had ever seen. When that bubble inevitably popped, their stock market collapsed by a staggering 80%. It did not recover in a couple of years. It took 30 long years to get back to even, which completely ruined the retirements of an entire generation. The warning signs flashing in America today are the exact identical data points seen right before the Japanese crash. History does not always repeat itself perfectly, but it loves to rhyme. To find the true winners after the dust settles, I use a strict 4-step system based on deep historical analysis. Step number 1 is what I call deep value recovery. The absolute most beaten down and hated sectors of the economy always produce the most explosive upside moves. When mass panic hits algorithmic trading systems and leveraged hedge funds are forced to liquidate everything immediately, fantastic high-quality businesses suddenly start trading at prices that imply the company is going bankrupt. When the irrational fear finally subsides, the rubber band snaps back, and the quality companies skyrocket. We look specifically for solid businesses that have dropped 70% or more from their previous highs. Step number 2 is filtering out the garbage by identifying strong secular tailwinds. You must understand that not every cheap stock is a good investment. Look at a company like PayPal, which looked cheap on paper but kept falling until it was down 85%. Some companies are cheap simply because they are badly run or their business model is dying. The true winners are companies riding long-term trends that will last 5 to 10 years regardless of a temporary recession. Think about long-term themes like global digitization, renewable energy infrastructure spending, or healthcare for an aging population. When the crash inevitably ends, these specific companies do not just recover to their old highs. They blow straight past them because their underlying business actually grew stronger during the economic downturn. Step number 3 is focusing on industries that are simply too big to fail. Modern governments cannot afford to let critical systemic infrastructure collapse under any circumstances. They will always step in with massive bailouts, federal loans, and artificial liquidity injections to prevent a total societal breakdown. During the 2008 crisis, major financial institutions got flooded with government cash and subsequently went up 6 times in value. During 2020, the airlines and energy sectors received massive indirect support and rallied furiously. Look for defense contractors, critical mineral producers, financial institutions, and auto manufacturers that the government needs for national survival. Step number 4 is mastering the cyclical commodity market. When the economic recovery begins, there is an immediate insatiable demand for raw materials, like copper for electronics, oil for transport, and steel for building. That is precisely why resource companies consistently deliver 7 times to 10 times returns during a market turnaround. You want to target commodity producers that maintain incredibly low debt levels so they can easily survive low prices for a short period. The most important part of this entire game is not just finding these investments, but knowing exactly when to take your profits.